In this episode, we're going to look at models that went wrong in different ways. My name is Andrew Smith, and I'd like to welcome you to this masterclass on the subject of model risk. I'm going to start off by looking at a series of examples of models that went wrong, and then we're going to review those and look at some of the theory as to why models go wrong and what we can do about it. So I'm going to start by looking at an example that's quite notorious. This slide shows a paper by Reinhardt and Rogoff on the topic of debt. And what they found, they looked at several countries in the world, and they looked at the relationship between the debt of the country and the economic growth. And what they found was there was a tipping point. When a country had debt that exceeded 90% of its GDP, then that hindered the growth of that economy going forward. So why does this matter? This paper was widely quoted during the years after the financial crisis, when governments around the world were implementing austerity policies. And the austerity policies involved reducing government spending in order to prevent the government debt growing. And of course, that reduction in government spending had knock-on effects on schools and hospitals and other services that were provided to a lesser degree, and people suffered as a result. So why am I showing you this? Well, a few years later, a PhD student had a look at this work and tried to replicate the results. And he found that he couldn't do it. He couldn't get the same numbers that Reinhardt and Rogoff had got. So he contacted them and they sent him a copy of their spreadsheet. And it turned out that that spreadsheet had some mistakes in it. Some of the data was incorrect, and there were some key formulas which were wrong. Several rows had been omitted from the formulas, so the averages were wrong. And when you restated the calculations with the correct data, the conclusions changed. So that meant, on the face of it, that millions of people have been put through austerity on no grounds at all because of a mistake in a spreadsheet. Now, of course, austerity wasn't caused by the mistake in a spreadsheet, and it could well be that the governments would have implemented those austerity policies regardless of the academic research. They didn't wait for the academic research, but they chose their policies and then used the research to back it up. But nevertheless, this is an example of where a failure in a model potentially had far-reaching consequences for society as a whole. What you can see on your screen are some value at risk calculations from two large financial institutions in 2007. One of those, AIG, is a large American insurer. The other, Fortis, is a Dutch bank insurer. Both of these organizations calculated value at risk, and that means the amount of money that they might lose for a very, very bad event. And that very bad event is expressed in terms of how often those events come around. So the benchmark that Fortis used was 3 in 10,000. They reckoned that they could work out how much capital they needed to withstand a scenario that was so bad it would be the worst in the top 3 out of 10,000 years of events. But it was unlucky timing, because in 2008, both of these institutions managed to lose well over and above the amount that they said they might lose in these very rare events. And this wasn't just bad luck. It was clearly the case that some of the things in those models were not right. Some of the assumptions were invalid. Some of the calculations didn't stack up. So the financial crisis exposed the weaknesses in these models. And you can look at how extreme the event was according to those models. I'll take the example of Fortis. So Fortis managed to lose nearly double the amount that they said that they might lose in their 3 in 10,000 event. And if you extrapolate that from the normal distribution, the amount they lost would be a 1 in 12 million year event, in theory, according to the model. Now, of course, 12 million years is a very long time. Human beings have been on this planet only for a few 100,000 years. 12 million years ago, the Mediterranean Sea dried up. There was a mass extinction. Then the Straits of Gibraltar opened up again, and it flooded in another massive extinction event. So lots of incredibly disruptive things have happened in the last 12 million years. So this picture shows the report of the Laidlaw inquiry. And the Laidlaw inquiry related to the franchising of a railway line in the UK. And this was the West Coast Main Line. It goes from London up to Glasgow. And under the UK system, the railways, they're not run by a nationalised company. They're run by private companies who operate those and there's a system of government tenders to award those contracts to different private companies. And this West Coast Main Line came up for refranchising, and several companies put in their bids to operate this line. And it was awarded to one particular company, and one of the other companies was aggrieved at that, and they looked through the details, they looked through the bids, and they thought that the government had made a mistake in its decision making. So they issued a court case, a court challenge. And what transpired was that there was a mistake in a spreadsheet. There was a calculation about the treatment of subordinated debt. The winning company was planning to issue a large quantity of subordinated debt. That made them much riskier as a provider of railway services. And the government's analysis by the Department for Transport had failed to notice that. As a result of which, the franchise had to be abandoned. There was a cost, £50 million or more, and huge embarrassment all round. The incumbent operator continued to operate that franchise in the meantime. But very significant losses from a mistake in a spreadsheet. And the Laidlaw inquiry looked into the circumstances surrounding this. One thing became clear, that it's not just a mistake in a spreadsheet. It's the fact that the systems and controls around that were missing. Nobody was checking that this was right. There was a lot of rushing of the process. Things were not properly verified. Things were not properly audited. And there were too few checks and balances. There was too much fly-by-night, just do the best you can in a short period of time, as a result of which this mistake crept through. So this picture shows credit ratings of corporate bonds. I'll explain the background to this. Many companies and governments indeed issue bonds. It's a way they borrow money. And the major rating agencies, in this case Standard & Poor's, provide ratings for those bonds. And they rate them on a scale that goes from AAA, which is very strong, down to D, which is in default, and there's A's and B's and C's in between. And there's a big partition between those which are called investment grade, which is BBB and above, or those that are called sub-investment grade, or informally called junk bonds, which is BB and below. And what this chart shows is the fate of bonds which started off BBB at the start of a year. And the big grey area in the middle shows that at the end of a year, most of those bonds remained at BBB. And I've got 40 years of data here. And on the left-hand side, I've got the bonds which were downgraded. And that's a very significant event for investors in those bonds if they're reclassified as being sub-investment grade rather than investment grade. On the right-hand side of the picture, I've got upgrades. Those are bonds which were reviewed and found to be more creditworthy than had previously been thought. Now, insurers and banks are interested in how often is it the case that lots of bonds get downgraded. And you can see in this picture there have been a few bad years in this history. The 1930s, which isn't shown here, were much worse. And the data tends to get worse as you go backwards. Now, I want you to imagine that you're sitting there in a bank or an insurer and you're trying to work out the risks associated with those bonds. And so you'd look at this historic data and you'd build some sort of a model. Now, I was doing this before the financial crisis. I was producing models of bonds, of downgrades, of yield spreads, the things that could go wrong with bond portfolios. And there were several different views as to what drove these markets. Some people said that you've got these bonds with a significant spread over low-risk bonds, and that spread is to compensate you for default risk. And so there were some scenarios where somebody who invested in these bonds, they wouldn't get all of this extra return. They'd lose some because they defaulted. And actually, you could look at the spreads on those bonds to guess how likely default might be. There were other people who said that the spreads on these bonds were there because of illiquidity and other market imperfections, and it was essentially a free lunch. So that meant that investors who held those bonds, at least if you didn't have to sell them, so if you were insurers backing somebody's pension, you wouldn't have to sell those bonds. You got a free ride on these higher returns because you were being compensated for illiquidity, which didn't affect you. So there were these two competing theories, and I had models which would produce bond scenarios under either of those bases. But what I can tell you is that I didn't have any customers for the first kind of model. Nobody wanted to come along and pay good money to get a model that could tell you this could go horribly wrong. They wanted to tell a story, which is that we're absolutely fine. There's very low likelihood of anything going wrong. And so the second kind of model, which were much more upbeat and really minimize the risk of things going wrong, they were flying off the shelves. And so the models that got used were not representative of the models that had been built. So this picture now shows a history of yields on index-linked bonds in the UK. And in the UK, these bonds are inflation-linked, and so the yield shows the guaranteed return that an investor might get or will get in excess of inflation, and these are over a 10-year period. They're 10-year bond yields. And the black chart shows the history of those bond yields. If you look at the left-hand part of that chart, about 1995, you have a fan going out there. And that's a model, very famous model, called the Wilkie model, which David Wilkie published in 1995. He took the history of those bonds, and there wasn't much history, actually. Those bonds were only issued in the first case in the early 1980s, and so there wasn't a lot of data. And what the chart shows, those blue lines show, according to the Wilkie model, the 5th percentile and the 20th percentile, the 35th, the 50th, the 65th, the 80th, and the 95th percentile, so going up in jumps of 15%. And it shows the distribution of results that David Wilkie's model said was going to happen in future for those real yields. And what he did not know, but we do now know, is that the market yields went down, and very quickly, within a few months, in fact, had fallen below what the model said was likely to happen. And so David came back a few years later, and 15 years later, he published another version of the model and acknowledged that the model previously had gone a bit wrong, and produced some new parameters and some new formulas and proposed a new model for index-linked gilt yields. And I've shown that also. That's in the red lines on the chart. And that also was overtaken by events fairly quickly. And so now we're in a situation where index-linked gilt yields are around the -2% mark, and none of the models that were widely used at the time showed this happening, at least not the models that were used by the pension funds who have the inflation-linked liabilities that really ought to be concerned about those yields. I'm going to turn now to models that you might be using at the moment and talk about some of the uncertainties that underlie those models. You can see there a chart which shows the number of deaths on a weekly basis in Ireland resulting from COVID since the start of the COVID pandemic in March of 2020. And you can see there's been two spikes. There was a spike originally in the spring of 2020, and then calmed down for a bit. And then in the winter of 2020 and the winter of early 2021, we had a spike of infections and deaths. And I want you to imagine that you are now responsible for contingency planning, and you are trying to produce a very pessimistic forecast for COVID deaths starting now and forecasting ahead for another year. And you're trying to find something which is at the 99.5th percentile. So there's only a 1 in 200 chance of the outcome being worse than that. How would you do that? Well, of course, you could fit some statistical models to this data, but there's very limited data. And there's things that we know which have changed things. We know, for example, that the universities and the schools are opening up. I will be teaching face-to-face students in 2 weeks' time in September of 2021, and we haven't done that for a year. So maybe that's going to increase the rate of propagation of this disease. On the other hand, I've been vaccinated, and so have most of my students, and that should reduce the disease's spread. But if you're trying to produce a forecast, there are so many things which you could potentially get wrong. Some of them are things which you don't know, but there are also things which can come out of nowhere, the so-called black swan events, which haven't been seen before. And indeed, had I been giving this talk 2 years ago, as we had planned to do before the pandemic came along, nobody saw this pandemic coming either. This picture shows another set of model output, this time from the International Panel on Climate Change. And I think it's a really good example of showing model uncertainty. What we can see here is the International Panel's forecasts of temperatures and of sea levels. And those temperatures and sea levels are shown in a number of different bases. There are several different scenarios which are sets of assumptions about what we do as a society in terms of carbon emissions. So that's one level of uncertainty. How will human society act in future? Then there is a second level of uncertainty, which is even if we know exactly how much carbon dioxide is going to be put into the atmosphere, we still can't immediately predict what the impact is going to be in terms of temperature. So these charts show two levels of uncertainty. Firstly, the uncertainty about what people and society will do in terms of emissions. And secondly, the uncertainty about how the climate will respond given the levels of emissions, and showing the consequences of different assumptions, these different pathways, as well as showing the consequences of the inherent uncertainty for any particular pathway. So to sum up from this introduction, we've seen models which went wrong in all sorts of different ways. We saw models that went wrong because of human blunders. Somebody simply made a mistake and put the wrong formula in a spreadsheet. We've seen models that went wrong because of some complicated calculation, and somewhere inside that calculation there are some assumptions or something that means that some large banks and insurers hugely understated the risk, the amount they might lose in a downside event. And then we saw some models, some quite nice communications from the International Panel on Climate Change, and these models showed some good ways of explaining the uncertainty and communicating the things that we don't know, as well as the things which we can estimate with some confidence.